Good morning. Welcome to Forex.Today, the YouTube community of almost 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. Let me know how it can help. Oh, look at that. It looked like Dracula. Dracula. Count Dracula. Hey, relax, Wayne. Relax. How about this? That's a little better. Let me know how it can help. Technical and fundamental analysis is what we're here to cover. So ask questions, get involved. If you look in the description below the video, there's a link to my book, Strategic and Tactical Forex Trading. You can buy that. Don't worry about it. You're not going to make me rich. The publisher, Wiley Publishing, makes about 90% of the money. So, but I think it'll be helpful. If you join fxbootcamp.com, it's 65 hours of foreign exchange trading videos. Teach you things like trader psychology, macroeconomics, monetary policy, price action, pivot points, day trading, swing trading, and a whole bunch more. Don't worry, you're not going to make me rich by joining. It's $88 a year. Cool. I also recommend, and you'll see the link in the description below, to tradersway.com. I believe that they're an ethical foreign exchange broker with a business model that is symbiotic to your success. Meaning if you're successful, they're successful. If you fail, it doesn't help them in the slightest. You're like, Wayne, you just want me to click that link so that you can earn commissions. Don't click the link. Don't worry, I don't earn commissions. Just like, you're not going to make me rich by doing that. So, hey, I think those are resources that are going to be helpful. That's why I recommend them. Isn't that nice? Breath of fresh air. So while you're here, again, let me know how it can help, and I will do my best to contribute to your success. That is the raison d'être. And here he is. This is just where we left off in the day trading group, so we'll just continue here. This is what we call a trend. One of the things we're talking about is how retail traders tend to get caught in small time frames. They typically look at a 1 hour chart or less. 15-minute is probably the norm. Maybe once in a while you look at a 4 hour, but very often you're caught in the smaller time frames. And what you'll notice is that this is on a large scale. Let's do this. I'll make this a little thicker. On a large scale, I think you would agree this is down. On the smaller scale, what you'll notice is there's periods of up. And one of the whole points, if not the main point of my book that I wrote, I don't know, what was it, 13 years ago? Is that you want to use your whatever tools you're using. I like to use moving averages, for example. And I want to separate price from market. Okay? Oh, that's cool, Denise. Let me know why it was awesome. Why was the session with Ryan awesome? Let me know. So, anyways, the whole point of the book is we need to separate the market from price. The market in this situation is bearish by technical definition, not an opinion. And then price, you'll see some point in some periods head up and in other periods head down. But you'll notice that the down periods tend to be larger than the up periods. And so that's what you're trying to do most of the time. Oh, is that right, Denise? That's funny. Yeah. Well, that's the whole point of my book. you know, so I'm glad. I mean, that's the cool thing. So I've had other coaches that have helped me over the years, and many of them are great coaches. But the best thing about those coaches is that I've taught them how to trade. And so to hear that Ryan has done just something similar, which is great because that's the right thing at the right time to be talking about. Even though every person trades slightly different and incorporates other things, when you strip everything down, you get to the basics, the foundational part of trading. It's always the same: buy low, sell high. And that's where we're all trying to get to. So whatever technique or tools you use, we're all trying to get down to that, or you're asking the wrong questions. If you're not trying to get down to how do I buy low and sell high, then it's probably, or how do I let my winners run? Then those are the only two questions that probably matter, right? So anyways, that's good. That makes me happy. Okay. So this is where we're trying to get to, but here's the thing. On the smaller time frames, we tend to get lost in the shuffle of it's going up and it's had a big move up and then it's going sideways and we get frustrated and then it pops up. So now it has to go up and then it comes back down and then it comes back down and we get frustrated, don't we? Oh, it's a big move, so now it has to go up. So you buy it. And then it comes down. Oh, it's a lower low. I guess I need to sell it. And then it goes back up. And then you're like, I guess it's range trading. And you're making some profitable trades, some unprofitable trades. And then it makes a higher high. So what? I sold it. What the heck? You sold a higher high? Well, sorta. And so retail traders, and I don't mean anything offensive about that, right? I'm not trying to knock anybody down. I'm trying to make a point where you can get frustrated or even lose a ton of money. I find when the markets don't move, that's when I lose the most. So therefore, over time, when I find I'm in periods of low volume and volatility, I've learned the hard way to trade less and wait for the volume and volatility to return. Okay. So anyway, so you're like, well, this is all over the place. What's going on? It made a high and then stopped going. Then it made a higher high and then dropped. And why would you sell this? And like, it's all over the place, right? Oh, this is so frustrating. Maybe I should learn how to get rich by, trading real estate. And should I do single family homes or multifamily units? Like, what am I supposed to do? Or maybe I should trade options, or maybe I should do something else, or maybe all the money's in futures and you're just going in circles, right? And therefore I'm like, well, if you look at this chart, you sell right here because it's a role reversal in a falling market. You will also find that according to the rules of my book, right around there, June 10th, it's really, right? June, somewhere in there. That's when this market became technically bearish. And the only thing you want to do when the market is technically bearish is sell. So the point I'm hoping to make is that if you had created a bias that said only sell, do you think you could have done better? Because now you're spending your whole day, your whole week, and your whole month looking for opportunities to sell. And then you can use other techniques. you could use price action. Okay? Okay? So, for example, double top, and you're already bearish here. So it came down. Okay, double top, great. Lower low. So when you get your lower low, lower than this low, you take the old low and you drag it across. And that's your new sell. We call that a role reversal. New lower low, drag the old one across. That's your new sell. Lower low. Well, wait, I'm on this one. Lower low, okay. Okay, so you look at this area. New lower low, you drag this across, new area, okay. Lower low, look at the old one, drag it across. Now what do we do? Well, we need a new lower low, probably somewhere down here, and then right around where this profit target is probably a new sell. But the thing is, these are daily charts. So I have to let this fall for another week? Maybe 10 days? What? And then I have to wait for that to come up another week? Oh my gosh, Wayne, that could be 20 days to get the new lower low and the new lower high and the new sell. 20 days, that's like a whole month of trading. And I say, why? You get paid by the hour? Huh? Anybody here get paid by the hour to trade Forex? So what we're trying to train is, this is a key moment in time. Okay? And this is a sell, so we'll call that sell 1, sell 2, sell 3, sell 4, sell 5. Okay? Sell 6. And now we're planning sell 7. Using nothing but price action. Now, each one of these could be individual trades or they can be compounding trades. No, that's since June. Oh, no, you're right. That is last year. Sorry. Yeah. So your customer, I was playing poker years ago, and I struck up a conversation with the woman sitting next to me. And I'm like, hey, so what do you do? I'm a Forex trader. And you're like, no shot, no way. So we were talking about it, and she works for her family office, and they make one trade per year. Well, I'm like, no way, how long have you guys been doing that? And she's like, I'm like 3rd generation. They make one trade per year, and it pays for the year. Not just for her, but for the whole family. Interesting, huh? Yeah. Well, I'm sure I have. Hey, man. How many hours have I been, if I've done 6,000 videos on YouTube and then probably another, how many are not on YouTube? I'd have to say 10,000 hours of me sharing my, Really, when it comes down to how do you make a decision on whether to buy, sell, or hold? Well, it's the accumulation of your life. How do you make that decision? Right? So anyways, I'm sure I've mentioned that before, probably 10 times. But in certain periods, it's an interesting tidbit. So there are people out there, family offices, that would do like that. So they would get together, they would discuss it as a team, and they're like, we're going to buy the US dollar. Denise says, yeah, well, the lot size must be substantial. Yeah, but I bet you their stop is more than 12 pips away. Okay. And then also, Denise, what kind of information are they using to make their intelligent decision? See, again, this is radically different from what a retail trader who's listening to gurus on YouTube trades. So I'm like, well, here's a family that's been trading Forex for 3 generations. Her grandfather was a Forex trader. Her father was a Forex trader. She's the Forex trader. Went to university and everything to be the next round of the lineage. And this is how they do it. So your customer says, yeah, so retail traders often don't have the money for that. And you're totally right. It's true. But it's hard to get past to the point of never having money if you trade now like you don't have any money. At some point, not just the strategy, but sort of the attitude needs to change. You need to trade like you need to change from you got nothing to lose, so you risk it all to get to the next level. But the thing is, if you're betting big because you have a small stack, you're almost certainly going to lose your stack. This is an analogy from poker. Once you get to a point where one person at the table has 5 times more money than everybody else, the other ones need to bet a bigger because they need to like double their stack. It's no big loss for the big person at the table, but for you got to get some power at least to compete against the other ones that's still at the table. So you should bet bigger when you have a decent hand because you might actually win the hand. And that would really help. And now you have more capital. The problem with that is this is not a game. So in the beginning, I understand the logic of taking more risks so you can have more money. But the problem is in the beginning, you most have no idea what they're doing. Maybe they know some technical analysis. Almost certainly they have a very vague concept of fundamental analysis. And even with their technicals, even if their technicals are pretty good, they don't have the experience. So they don't know when to hold them, when to fold them, when to walk away, when to run, when to double down. They don't have the experience. So maybe they have a decent strategy that an experienced guru on YouTube showed them, but they don't, even if they understood the concepts, they don't have the experience. And so what happens is like vague notions of fundamentals, mediocre understanding of technicals, and very low levels of skill, but you've jacked up your risk size. You see, you're like, now it really will come down to luck. But the problem is, if you trade a lot and everything that you're doing is relatively mediocre, mostly because of lack of experience and some knowledge, you must agree that is probably the case. It's not that you're a bad person or you're dumb or something. You just need to know more and you need to have more experience. So therefore, in those situations, what would be logical is you would trade either on a demo account or with smaller lot size until you get more experience, until you increase your understanding and knowledge. And then you would increase your lot size, especially after a period of decent success. But if you're going through a period where you're very inconsistent or consistently losing money or inconsistently making money, but you're jacking up your risk, like, it just doesn't make any logical sense. Right? So that's the thing, your customer. If I can make a breakthrough, it'd be like, in the beginning, if you don't have money, treat it like going to university. Take Forex incredibly seriously for 4 years. During that time, don't trade to try to make money. Trade to learn how to trade. Study fundamentals, study technicals, study different techniques. My techniques, other people's techniques, whatever. But use it as 4 years of research while you have a side job so you save your money. Okay? It's kind of like going to university, but you have a job bartending or waitressing or waitering or whatever. Okay? Or you move to Hollywood to become a star and you bus tables. But you spend time going to auditions. Talk to anyone who's been successful in the, you'll find that that's a normal situation. So do what you need to do, plus work a side gig, plus study for 4 years. Yeah, right on, Johnny. Has it only been, you said, hang on, there's something in the way. I got to get rid of this. You said 2 years? Yeah, for 2 years. You know, Johnny, you're a good trader for only 2 years of experience. So congratulations. Yep. So your customer, I'm just saying, I'm giving the message, but I know people are going to do what they feel is the right thing to do in the beginning. And that's everyone's decision. When I first started trading Forex, I had an extremely good job. So I traded Forex for 2 years on a demo account. I didn't need the money. And I didn't want to quit my job. I had an awesome job. I was a supermodel. Oh, and a venture capitalist. So you're like, cool. So it was golden. So I traded for 2 years on a demo account. Cool. Other people may not be in that situation. Okay? So that's all. So I'm trying to share what I believe is to be the truth. Veritas. The truth through knowledge. And then everybody makes the best decision they can in their individual situation. And I wish you success. But above all this, I'm wishing you love. Wishing you joy and happiness. Yeah. So anyways, there's one way to look at the market. Okay. And we'll see. This is the 1, okay, and we have another about 50 pips to get down to parity, and I don't know nothing about no parity. It shouldn't matter because technically and fundamentally it's irrelevant, but we know psychologically it makes a ton of sense. I want to have this lower than that, so I'll just make the point. Let's bring this down. Okay. So technically it should fall. Fundamentally it should fall, but that psychological level matters. Okay. Paulo says, yeah, 5th year trading on a demo, almost there. Awesome. Evans is now consistent. Awesome. Meta says we all have different realities. Yeah, and it's interesting. We're all on the same rock floating around the same star, and yet we all have different realities, huh? Isn't that interesting? All right. Let's take a look at the indices. Dollar ripper strong, pound ripper weak. Good. 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 Oh, I didn't want to go there. I wanted to go piggy, piggy, piggy. Can't you see? All right. So I've been picking on pound CAD, pound Kiwi, pound Aussie for a while now. And it is falling. Last night in the swing trading group, we ran into some technical problems. It was real pain. But about, I don't know, what, 1/3 of the people were able to stay an extra hour until we got that technical stuff, I don't know, not fixed, but we found a way around the problem. Not with us, it was Zoom. Zoom. But the plan yesterday was I had I had fundamental analysis created for 4 different pound pairs. And the plan was I was going to give 4 different groups, 4 different fundamentally based plans, and that each group would come up with technical trade plans. By the time we got through it all, there was only 2 groups. But here's what I'm trying to get to. For weeks and weeks and weeks, I've been pointing down for the pound. Meaning I've been a bear on the Great British Pound. Over that period, there were great times of bearishness, but then other big rallies. We're talking about like for a week or 2 or 3, there could be a big bullish rally. But the fundamentals hadn't ever changed. And so I've been preaching for weeks now, sell the pound, sell the pound, sell the pound. As a technician, though, you have to decide, is this the right price and time to sell, or should I wait for a different price and time to sell? But the fundamentals don't change that often. And so last night, my plan was to give everyone, give 4 different groups with 5 or 6 people in each group, a currency pair selling the Great British Pound. And, yeah, that's looking pretty. Okay. Okay. Look at that, guys. Pound Swissy. Go out to here. Look at that. Pound dollar. And we had good plans. My biggest advice, because the plans that were given were logical, intelligent trade plans, just like I teach. But my biggest feedback was, what if there isn't a pullback? What if it just falls fast? Because as new money comes into the market, what if all that new money is just bearish British pound and that there isn't a bigger pullback? And I said, so I'll keep that in mind. Or should I say, bear that in mind, right? So anyways, so here we are on a smaller time frame now, okay? Remember what I just did? Okay, so there's your double top. And so if Kiwi's going to be strong today, it's going to do something like this, right? It hasn't happened, but Kiwi may not be strong in the moment. Okay. And by the way, for those in the swing trading group, because I had to log out and log in and trying to fix Zoom, and because I was support with Zoom, and they kept sending me like, send me a screenshot of the file that's not appearing. I'm like, well, how do I send you a screenshot of nothing? I mean, it was so silly. But I had to log out and log in, and that killed the recording. So there's part 1 and part 2 in the videos. So look for that and catch part 2 where we're shorting the pound. I think, what did we cover? Was it pound Swissy, pound dollar? I think so, that we had that. So like 8 hours ago, we're here talking about shorting, and we're here talking about shorting. Well, here actually. Cool. You want to know something interesting? Okay. Going back a week ago, I reported the position of retail traders. Okay? So right here, were retail traders long or short? Were the majority of retail traders right there long or short? Take a guess. The majority. Obviously, there were some long and some short. But how is the market, retail market, overall positioned? Long or short? Come on now. Yep. Tap those keys on your keyboard. Okay. Now the second part, because that is correct, they were long. What percentage of the market, of the retail positions were long? What percentage were long? Was it 55 long, 45 short? What percentage? $95. $95. Not 50. $95. Let me tell you, institutional investors were not positioned that way. If my mind serves me correctly, for Great British Pound, institutional investors, okay, so invest, okay, for the British Pound, I believe it was something like 65% were short the pound, and in dollar terms, 81% were long, which makes pound dollar heavy. Correct? So 2/3 of institutional investors were shorting the pound and 80% were buying US dollar. HM, I can fix you. I have a macroeconomics degree from Harvard. I'm probably the only guru on YouTube that can say that. I also passed the Series 3, which is a fundamental examination of the futures market. So yeah, join FX Bootcamp. Whoa, 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 super expensive. Okay. For $88, go through the monetary policy training course, which is probably, 12 hours long, and then do the macroeconomics course, which is probably about as long, maybe a little bit longer. There you go. So anyways, check that out. So when you're looking at pound, they were shorting pound and buying dollar in great quantities. And practically the entire retail, right, market was long this pair. And the vast majority of institutional were short. And what do you think happened here? What happened? Why such an acceleration when we broke through this period here? Why the acceleration to the downside? You're correct. Exactly correct, everyone. That's retail getting stopped out of their trades. It may not be more sellers selling, less bulls in the market. Okay, those bulls are being slaughtered. But it's not really by the bears. Now, there might be a slight increase in the institutional bearishness, and we'll find out later today in the new Commitment to Traders report, because that's where I get these statistics. I'm not making it up. And so when we get the new statistics, what we'll find is there's going to be a heck of a lot less bulls and maybe just a little bit more bears. What do you think? Smell like a plan? William says on C-Trader copy trading, he is number one for 2.5 years. Cool. Send me a link. I'll look at your returns. I've seen, of the thousands I've seen, when I look at the best traders, and you're saying you're one of the best traders, I'm super happy for you. I'm 99% sure I'll look at your trading results and not like them. I won't like your results. But I'm super glad you're doing something right. But I don't know you and all that kind of stuff, so I don't really have the right to say such a thing. But I can say, of the thousands I've looked at, when you look at the best are uninvestable because they're the best in the moment because their risky trading just happened to probably randomly produce what looks like to be good results. But the other 999 traders that traded poorly didn't get so lucky and busted out. So you could start at a poker tournament and gamble foolishly and win the tournament. But it doesn't, right? But it doesn't change when you do risk-adjusted performance where you're looking at probabilities and you'll say, well, you won a bunch of hands when you probably statistically should have lost, but luck crept in, right? So I don't know if that's you. I don't. But I would like to look. I always, right? Yeah, Thiago would say, what is your Sharpe ratio? That's really good. So if I'm an institutional investor and I'm like, well, do I invest into William in his Forex trading? Or do I invest into real estate? Or should I buy the S&P 500? Should I trade in oil? And by the way, I want to do that next. And that's what you would look. That's why you use Sharpe ratios. Or Sortino ratios are different. So Sharpe and Sortino work together. And then Sortino went and updated the Sharpe ratio. So it's just a different Sharpe ratio. But you would start, as Thiago says, you would start with a basic question like that. What's your Sharpe ratio? And you'll tell me 0.8. And I'll say, not even interested in looking at the rest. No, thank you. And you're like, oh, but I made 1,000 trades in a row or whatever it is, right? Yeah, if you have the link. I would look at it. But why don't you just tell us, what's the Sharpe ratio? If you say 0.8, I'm not interested. No, thank you. And you're like, but I got all these great results. I've done this and I've done that. I've done this other thing. I'm like, well, congratulations. Good. But I would never invest. And an institutional investor wouldn't even give you a meeting. So see if you have it, William. Now, if you come back 1.5, okay, I'll take a deeper dive. Yeah, HM, I might have to go that direction. My son said the same thing, but so maybe. Yeah, I got you, HM. All right, so let's do that. So that was that. I hope I made my point. Cool. So buying dollar has been a theme that I've had for months. Selling pound is a theme I've had for months. Let's take a look at our commodities. Okay. Cool. Just like I've been showing you. Oh, I have to do this in a different color. You're like, Wayne, what do you mean? What have you been showing us? Let's do it again. Okay. You make something, right? You breach this to make a higher high. So what do you do now? You want to buy a higher low. Where do you want to buy a higher low? Not somewhere around there. Not. Cool. So you got this up, down, buy. Cool. Great. Cool Mo D. Yep. Hey there, boo boo. Okay. That's that. So it'd be great if we can continue up through our consolidation into another higher high, which would then bring this back around. I think I'll update this a little bit like this. So maybe next week we can be climbing Jacob's ladder above the resistance and then be in a technical bull trend. We're not quite there yet, but boy, am I hopeful, because during this whole period, okay, I was a bull, but didn't want to trade. Then it went through this period, this period here, and I didn't want to trade because what I expected was something like this. And then, and by the way, we talked about all of this even back in July, but certainly on the way down in the yellow area, I said, okay, it's falling. I don't know how far it's going to fall, but I want to see a double bottom first before I even anticipate a higher high. And I don't really want to consider it a trend until it then makes a higher low. Can anybody confirm all that? Well, that confirmation is happening. This is what I'm hoping is happening next. What do you stink? Smell like a plan? Right on, William. Yeah, and by the way, William, I'm not knocking you down. Dude, I'm telling you, congratulations. Being number one is no easy feat, no matter what. Now that you trade well, you're a good trader, I wouldn't rest on your laurels. I would get educated on a couple of things. The analysis, the risk-adjusted analysis of your performance, and what larger, more institutional investors would look for, so that you can start tweaking and improving your results to probably be better results. Even though you're number one, doesn't mean you can't improve. When Tiger Woods was way better than every golfer on the planet, he still had a golf coach. He still took advice from his caddy. Okay? Number one just means the competition is weak. But you certainly could have more capacity to improve. So then you would want to okay, well, what are the good performance indicators? Being better than all the crappy traders is only one step, right? So you're like, okay, everyone else is crap. Good. So you're the one that's not crap. But could you improve? Almost certainly. YouTube says, Wayne, wouldn't that oil analysis be awful for stocks? Yeah, probably. Yeah. Yes, it is. Not always. In other times, YouTube, oil would be going up because the economy is doing so well. So it's risk on for everything. Americans are spending money like crazy. Factories are humming at full capacity. And energy is in crazy high demand. So in that scenario, which is more normal, you would have S&P 500 and WTI probably with a high positive correlation. But you're reading it right now where you're like, okay, wait. We don't have a situation like that. We have a slowing down economy, at least in some parts right now. rates rising and expected to continue rising for probably another 12 months before any kind of pause. There's a global recession going on. And WTI is going up. Wait, that's not good because there's no demand. So why would WTI be going up if there's no demand? Oh my God, there's no supply. So you can have an economy that's falling because the central bank is jacking up interest rates to slow the economy down, to reduce inflation. But the thing that causes inflation the most is going up despite that. Uh-oh. And what can the Fed do to produce more oil? They can do stuff to diminish demand, but can they do anything to increase the supply of oil and natural gas? No. So in that case, in that scenario, if that plays out, WTI goes up, stock market goes down. Uh-huh. Well, technically, the Fed doesn't print money. The Fed uses credit. Okay? Like, think about it. The economy is doing bad. The Fed uses, right, money. It uses ones and zeros on computer screens to buy bonds. Think of it as a loan or a credit card. Think about it as a credit card. There's no money on your credit card. There's only credit. You don't have any money. You have a credit card. So you go to the store and you buy it. It's a loan. Okay? But instead of buying a piece of junk, you buy a bond. And then later on, you can sell your bond and pay back the loan, and that money is gone again. You don't have the bond, you don't have the debt, okay? You see, it just can come and go. But nothing was it was all based on credit. So who prints money? Oh, print the oil. Oh, I see. Yeah. Well, synthetic oil, right? Well, that's why, for example, I think it was Malaysia, it might have been Indonesia, one of those countries banned the export of palm oil. Because there's a short supply of it. And now you might, if you live in Indonesia or Malaysia, you might use palm oil to cook. If you live in America, it might be biodiesel. Was it Indonesia? Okay. Correct, Richard. It's not Janet Yellen per se. The actual answer is the Treasury, not the Fed. The Treasury prints money. They have the printing presses. The Fed uses credit. Okay. The Fed uses credit cards to buy a bunch of bonds. And when they need to pay off their credit card, they sell all their bonds. And now that debt goes away. That credit, right? Do you understand the difference? It's interesting. The Fed doesn't use money, it uses credit. That's why it's not a big deal on inflation. Oh, we have inflation? Sell the bonds. Oh, we have deflation? Buy the bonds. Oh, there's inflation? Sell the bonds. Oh, there's deflation? Buy the bonds. Oh, there's, right? Not a problem. It's just credit. Is the money going, is when the Fed adds money, if you want to call it that, does it give the money to the Amazon.com warehouse forklift driver? How much money does a warehouse forklift driver receive from the Federal Reserve Bank of the United States? Or the grocery clerk bagging groceries. How much does she get? Okay. How about the person working the coat check at a strip club? Which is really funny, right? Hey, even strip clubs need coat checks. Think of it. The answer is none, right? So when the Fed, as the media says, prints money, which is wrong, where does the money go? Who gets the money? Banks. Actually, technically not all banks. It's actually bond dealers, which are banks, but it's the bond dealer part of the bank. And then the bank is able to then push that through the economy through loans, which you don't take a loan to save, you take a loan to buy. So then you buy an asset, and then that money then goes to whoever sold you the asset, and then they don't hold the cash. They don't even get cash. Where does the money go? To their bank account. And it goes from bank to 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 bank. And therefore, the Amazon.com warehouse worker has a job. Because Amazon can get credit, but then those buying stuff from Amazon have credit. And they're able to buy stuff, and there's a job for the warehouse worker. Okay? It's not very inflationary. You see? But the federal government gave money to the warehouse worker directly when the warehouse worker was not allowed to go to work because of COVID-19. So the government said, well, here's a few $1,000. That was inflationary. And it was money. Now, they also used it through credit. They borrowed money, got the cash. So they went to their rich uncle. Hey, Uncle China, give me some money. And then they took the cash and gave it to their deadbeat drug addict. I shouldn't say that, but I didn't mean warehouse workers were deadbeat drug addicts. So that's why I want to change that example. But the money went directly now, not through the banking system supporting the entire economy, but to an individual person. Okay? And that created inflation. Because it's instant. You understand? Hey, dude, here's a couple of $1,000. Boom. Check your code at the strip club. Of the people that received, so this came, it was either JP Morgan or Bank of America. I think it was Bank of America. The analysis said that when you look at people $5,000 in their bank account, I mean, that's as poor as you can get, right? So pre-stimulus, people that had less than 5,000, then the stimulus came out and suddenly they had more than 5,000. So, right, the report showed that after a year, almost all of that money was spent. So again, Before COVID, if you had 5,000 or less in your bank account, suddenly you had more than 5,000 in your account, and then suddenly you didn't anymore. So it came and it went. And the number one category of the spend, because remember, you spend everything on your debit and credit card now. It's not like you're writing checks, not like you're withdrawing cash. So now the banks know what you do with it. So you had no money, then you had a lot of money relative to normal, and then you don't have any money anymore. Where was it spent? Food and beverage. Not an asset. Not an asset. Okay? Not an asset. Food and beverage. Okay? So that instantly hits the market if you take your Biden money and you go to the bar and drink it up. It's gone. Okay? That instantly flows through the economy and can create inflation immediately, because you would not have bought that beer or whatever. You wouldn't have gone to Applebee's. You wouldn't have gone to Disney. You wouldn't have whatever with the money. I don't know what people did with the money. But if you didn't buy an asset, then it was, and you didn't earn it, then it was just purely unproductive. And that's what inflation is, by the way. You can look at it like it's just simply the value of money falling, but the interesting thing is the dollar's strong, so it's not being devalued. But I would look at it as unproductive money. Inflation is unproductive. If we were productive, if we earned the money, we would not have inflation because we had growth. We would have more stuff. Do you get it? And if you have more stuff, then the price per unit falls. Being more productive means prices fall. If you're unproductive, prices rise. You're like, I can't grow my own food. Oh, well, I'll grow food for you, but I'm going to have to rent land. I'm going to have to go to a bank and borrow money to then buy equipment, to buy seed, to buy fertilizer. I got to pump water out there. I got to spend time. And at the end of it, I need to make profit. The bank needs to make profit. The fertilizer company needs to make profit. The equipment company needs to make profit. And so as we add up all our profit margins and our own per unit cost, then it gets transferred to me. Then I will take, as the farmer now, I will take my profit that I need to make to feed my family. And at the end, I will sell all of that to you. And you're like, woo, prices are high. Well, only because you're not being as productive as I am. Okay? So finance is important. Economics is important. And the biggest skew to the math when you're doing economic calculus is, what is the government going to do? Because you know what the free market's going to do, but you can tweak it through rules and regulations and laws and all these different things. Some could be good, some could be bad. And that can mess things up. the economy itself can, right? So let me ask you, is the average farmer in the United States more productive or less productive than the average farmer in Africa? Which one's more productive? America or Africa? Anyone want to guess? Shouldn't be a hard guess. Shouldn't be difficult. Now, I'm an economist, so I don't care about anything except the economy. How does the economy work? I would reject something that it was like race or religion or some nonsense like that. You're like, no, dude. Education, maybe. Okay? But I think one of the key differences is this. If you're a farmer in the United States, like I said, you borrowed money from a bank to buy a bunch of land. And the bank also looks at your land as being a productive investment in which you partake in activities of buying seed, buying fertilizer, buying equipment, buying pesticide. You'll take the equipment and you'll turn over the soil, and then you'll take new equipment and you'll plant the seeds, and then you'll bury the seeds, and then you'll water the seeds, and you'll fertilize the seeds, and you water it again, and then you put down pesticide, and you water it again, and then you fertilize it again, and at the end of time, you go out, you harvest the seeds, and you separate the seeds, and then you got to maybe store the seeds, and then you got to transport the seeds, and at the end, you pay the bank a profit. You pay the bank back, because in the beginning, all you had was seeds and dirt, and at the end of the year, you have a grain, and you harvested the entire field. You had nothing, and you turned it into something. You were very productive, and it took a lot of work, and it took a lot of investment, and it took a lot of credit. So when fertilizer gets more expensive, you might use a little bit less, or you'll borrow a little bit more money and the margin falls, that your profit margins will fall, but you need it to grow. And there's a direct impact on using fertilizer and your yield. Absolutely confirmed. Cool. So in the United States or Canada or Europe, banking is a huge part of farming. You cannot farm in the Western world without a banker standing next to the farmer. In many third world countries, Africa being, having a few themselves, you will find that farming is a cash business. There's no credit. There's no banker. What you'll find is if fertilizer prices go up, you don't have cash. You're just like, I can't buy that. And your yields go down. And because there's no banking and finance and credit involved, people die of starvation. You will live longer. You'll get sick more often. Your yields will be way lower. You'll have less excess for trade. You'll have less money. Which means you have a lower standard of living, lower quality of living, less access to medicine, less access to food, less access to education, to safety, to shelter. Matters. Why? Because bankers are beautiful people. Well, banking is anyways. Huh? Have you kissed a banker today? Wait, it's funny, right? Because we're told that bankers are bad, that rich people are bad. And I'm a capitalist. I don't believe any of that nonsense. I hate it when you see in Hollywood that bankers are bad, hedge fund managers are bad, traders are bad, rich people are bad. And I'm sure some of all of those are bad, but they're not generally bad. And if you look at how capitalism works, oh my gosh. If you don't have banking and finance and credit in your economy, the likelihood of your child dying before the age of 2 is exponentially higher. And the likelihood of you living to 80 is almost zero. Unless you're Cuban, you can live forever. Cubans live forever. One of the oldest guys I've ever met was one of the toughest guys I ever met, and he was Cuban. I'd never forget him. He ate greasy food every day, and he smoked cigars all the time. And he was this tiny little old man. He was 1,000 years old, and he was skinny, and he'd walk around with no shirt on all the time because he would be working in the backyard. And I saw him one time when he was working in his backyard, and he decided a tree had died, so he had it cut and moved away. And they're like, "Do you want us to grind down the stump?" And he's like, "No, I'll do it myself." So he dug all the way around, got all the dirt out from the stump and the roots, and he was down there with an axe. And I don't know if you've ever tried to cut roots with an axe, but roots are so tight that they're dense that it's like stone. And anyways, so he's smoking the whole time out there in the hot sun, no shirt on. I don't think he even broke a sweat. He'd just work on it for days and days and days. Then he'd burn it and hack it some more. Meanwhile, he was eating burritos. It's California, so he's eating greasy burritos and out there. And I'm like, dude, that's how you do it, man. That's how you live forever. But for everybody else, capitalism is awesome. Bankers are beautiful. Okay. Richard says, yeah, America, we have more resources. Well, most resources are global. If you want to buy nitrogen, what's the other one? Phosphates, potash. Oh, you can have it delivered, I'm pretty sure, almost anywhere in the world. But you have to have either money or access to capital, right? In this case, credit. So you call up your local. So let's say you're in South Africa. South Africans use potash, I'm sure of it. You're like, you call up the local supplier of fertilizer. And you're like, yeah, I need some potash, whatever you ask, right? And they're like, cool. We'll place the order. It'll be here, in a month. You're like, right on. So who has the credit there? Well, the farmer calls up the supplier, and the supplier has credit, maybe. But then he needs to think the farmer has ability to pay. And then, that kind of stuff. And so at some point, somebody's got credit. Now, also, then the fertilizer needs to go from Saskatchewan to a port. And dude, Saskatchewan, right? There's like 3 places on earth where you get potash in significant quantities. Saskatchewan, Belarus, I think it is, right? And Russia. So guess where your potash is going to come from next year? Russia, Belarus, or Canada? Yeah, probably Canada. Prices are probably going to double. Where else do you get fertilizer? Natural gas. Oh, wait, natural gas prices in Europe are up 500%. By the way, when we were at 750, I can't remember if it was a day trading group or swing trading group, but when we were at 750, I said, can you imagine this going up 300% from here? And I said, I can. And I gave multiple general reasons for it, and one specific of why and when. But if nat gas goes up 300%, and that's where your nitrogen comes from, and there's a shortage of potash, all of a sudden you can see we're in a real world of hurt, aren't we? Yeah, it's going to be terrible in the United States and Canada and in Europe. Farmers are going to use a little bit less. They're going to make a little bit less money. Farmers in the worst situations could even lose their property because when they use less fertilizer, they get less yield, which pushes the price up more, but they have less to sell. And they couldn't afford the fertilizer, so even though they're selling it for more, they're not more profitable. They're margin takers. And I taught this in the oil course on Wednesday, what it means to be a margin player. So prices for wheat might be way up, but wheat farmers are not filthy stinking rich because of it. They're not gouging you to get yellow Lamborghinis. In fact, prices could be way up and farmers might actually have less profit. And some might lose their farms. It's terrible. Absolutely terrible. And I've seen it happen, by the way. I grew up in Saskatchewan. I've seen grown men cry. Men that never cried ever. And then they see their farm that's been owned by 3-4 generations go to the bank. Yeah, I've seen grown men cry, so I've seen it there. But you know what I also did not see? Is the other side of this situation. If seed prices go up, if fertilizer prices go up, whether the fertilizer is potash or if it comes from natural gas or comes from something else, they're not going to starve to death. They're not going to watch their children die. And in other parts of the world, that could be the case. Yields could fall so much that people starve. And that scares me. So those could lead to long-term trends. Long-term trends. Okay? But look at this. I have a number right now. The next target, when we were at 7.5, was 12.5. And I think that's the first move. Look, we were at 1. And I think the first move, we'll go from 7.5 to 12.5. And you're like, that's impossible. Dude, we were at 1. Okay? But I'll tell you what's really, really, really interesting is there's one thing I'm watching and waiting for that will, if you analyze how the energy complex works on a global scale. There's one thing that is going to happen and going to happen soon. It's not on your chart. It's not Putin, although he could really exasperate this and we can go from 12 to 15 or 20. But just one thing that is definitely going to happen. It might be in 3 weeks. It might be in 12 weeks. But there's one thing that will go pa-chow. You should be in my oil trading course because then you would know. You would know you could have an intellectual conversation about the entire global energy complex. From how it works to how to physically get the energy through the entire history and politics. Right now, I'm developing the course on legal contracts and structure. So if they find oil on your farmland, what kind of deal are you going to negotiate? But what if you're Exxon and you're developing a joint venture with some other oil company, and you're going to do this joint venture in Kazakhstan? Well, what does the legal contract look like? And what about the contracts with the people developing the land? Okay, because you got exploration. Okay, you have production. You have construction. Okay. Where's the liability? Who's got the risk? Who's put the most money in? Show me the contract. So that's what I'm doing now, today. So anyways, you should have a better understanding, because then you'll know, not only do I think this is going to pop, but I drew this line 2 months ago. And we're getting closer and closer to the thing. Wouldn't it be nice to know the one thing? It's going to cost you $250, my friend. Oh no. Okay. All right, so that's that. Let's wrap up here. We are now well into our third or fourth week of me planning this out. Here's the Fed meeting, less aggressive Fed. I drew all of these in an empty space. I drew this. Oops, we'll do it in blue so it stands out. I drew this. I drew all of those approximately 4 weeks ago. None of the candles existed. We were right in this circle. Okay? And look what ended up happening. It's not bad. We have this, okay, and then it took off, and then it came back, and it went up, and then down, and then went up, and then and then okay, not bad. Remember, I had to squeeze this in because we were so far to the right, right? I drew in this empty space. Well, I don't have that empty space now, okay? So I had to squeeze all that in, but nonetheless, what actually happened? Okay, we went up to the resistance area, and we also slammed into a standard deviation above the mean. And if you look at the slope of the mean, this is a bearish trend. Yet traders were buying, traders were bullish. Traders were like, oh, because of inflation, this is going up. It's wrong. You think you know. That's what you've been taught. And it is correct. Gold is an inflation hedge. But we already have inflation. That's where people are just so disconnected. Wait, what? Yes, gold is an inflation hedge. But we already have it. UK hit 10%. You don't buy gold when you're at 10%. You buy gold before you get to 10%. Okay? This is when COVID hit. And central banks, and I can prove this with fact, central banks bought gold. So if you're down here buying gold now because the UK has 10% inflation, you're like, well, my dad told me you should buy gold to hedge inflation. Oh, the guru on YouTube told me gold is the hedge for inflation. It is. Back in 2020. Here we had peak inflation. So what's going on now? We have inflation. So what would the Bank of England do about it? How about, right? How about sell gold and acquire Great British pounds to push up the value of the pound to reduce inflation? Wait, they would be selling gold. Gold would be bearish in a scenario like that. And I'm sure if you did a deep dive in research, you will find here and here and here, but starting here, central banks were selling gold to drive up the value of their currency, which is deflationary. You don't hedge after the fact. Think of it. So if your dad gave you that advice or that guru gave you that advice, that's as logical as saying that while you're standing there watching your house burn on fire and you're surrounded by fire trucks and firemen with hoses and lights are going off and water's everywhere and you're ankle deep in water, that you should be on the phone buying insurance to hedge. Dude, it already burned down. You should have bought it long ago. The hedge. You understand? So it's like, it's the right advice, but the timing is wrong. Okay? So again, members of FX Bootcamp, we talked about this over and over and over and over and over and over again on the way up. And I showed the facts. I showed the Reserve Bank of India. I showed the Reserve Bank of Israel, all that kind of stuff. And that's what they were doing. They were devaluing their currency. Inflation. They were creating inflation. Wait, you're supposed to buy gold in periods of inflation. The central banks were creating inflation on purpose. It's their job. And then when you got inflation, you do the opposite to reduce the inflation. So you're supposed to buy here and exit either here or here. So be careful. I think what happened in this period is, if you look at seasonality, gold typically goes up that time of year. And this would be the resumption of trend. Isn't that awesome? Isn't that beautiful? What a great Friday. Wasn't that awesome? Killer, right? Could you be so kind as to leave a comment on the recording, not the chat? I'm going to end now. Refresh your page in 30 seconds and leave a comment under the recording. Would you do that? Have a wonderful weekend. If you're in my day trading group, I'll see you Sunday night to trade to front run the London boys during the Asian session. Peace on earth. May the pips be with you. May your profits be above average. Hey,